If you've ever thought about investing your money, you've probably heard this one piece of advice on where to put it.
I'll be very simple. Under the conditions you name, I'd probably have it all in a very low.
Articles, books, influencers, and my high school econ teacher have increasingly promoted this special place to put your money.
Definitely don't do investing and just be willing to hold.
Statistically, this is the simplest way to build wealth for probably 99% of investors.
And slowly, American workers have funneled trillions of dollars into this investment vehicle. But its success is built on a 50-year-old theory of how the world works. And that theory might be off by a factor of 500. For the first time ever, funds that simply track large swaths of the market, like the stocks in the S&P 500, now have more money invested in them than actively managed portfolios. But as money continues to funnel in, some analysts are getting worried. People joining passive funds might be overvaluing stocks and could be leading the market towards a massive correction. So, should we keep going this direction? Let me step back for a second. The reason I got into this story was because of this chart, which isn't that different from this one or this one. These are graphs that track the overall growth of the stock market, and they're going up very fast. Almost too fast. And I'm invested in the stock market, so obviously I want the stocks to go up, but I'm also skeptical. Why is this happening? This is a story of
Index
funds.
how they slowly gobbled up the stock market and might be based on
A giant lie.
50 years ago, index funds didn't exist, but slowly they've gained their evangelists. One of the first people to pump index funds to me was my high school economics teacher, so I'm going to talk to him about why he thinks they're so good.
Hello.
There he is.
How are you? Good to see you. Thank you again for meeting with me.
Hey, it's my pleasure.
It's awesome. So I want to just ask you the biggest question. Why do you think index funds are a good investment?
Well, there's an awful lot of volatility in the market.
So the idea for an index fund comes from this long debate about what actually makes the stock market go up and down. As long as the market has existed, there have been countless theories trying to answer that one question. Because if you can figure that out, you can make a ton of money. And in the 1960s, economists popularized a theory called the efficient market hypothesis that became a foundational belief behind modern investing. Could you start by describing what the efficient market hypothesis is?
A giant lie. All right, that wasn't helpful for you. Sorry. The efficient market hypothesis just means that the current price reflects as much information as could be obtained in a economically efficient manner, and therefore prices are rarely wrong by all that much.
Explained another way, the efficient market hypothesis is like bidding on something you can't entirely see. Hey, today we're auctioning off whatever's inside of this box. Hey, that's a tail. Oh, I've seen this before. It's gotta be an elephant. $500. That good with you? Sold for $500. We've got 24 million more of these, folks, for the right price. 20 more sold for $500. $4.99. Oh, we've got an update. The object in the box seems to have a bitter leaf on it. Uh-oh. Sounds like a tree to me. $300. 500. 500. 475. 470. 400. Oh, fine. Sold for $300. $300. 300 sold. 300 sold. 301 sold. As you can see, the price of the box stock was immediately updated to whatever new information came out. It's basically impossible to predict what would happen next. Oh, hey, new information. That feels like gold to me. 600, 900, 1,000, sold. So if this hypothesis is true, no one, neither Warren Buffett nor you and I, can reliably beat the market, because doing so would require predicting the future. But if every stock is updated with new information, the most efficient way to invest would be simply to buy the market as a whole. And that doesn't guarantee the value will go up, but if it does, which it has historically, then you'll get as good of a return as anyone. But how do you follow the market? The most popular way to track the stock market is through an index like the S&P 500, which takes the stocks from 500 of the largest US companies, weighs them by their market cap, then combines them into one number. If the number goes up, those 500 companies' stocks are also generally going up. If it goes down, they're generally going down. So in the early 1970s, people tested this theory and compared their individual returns to the S&P 500. They found that over time, the S&P basically always wins out. But there wasn't an easy way to actually invest in the S&P 500 itself. So in 1974, after the idea had been floating around for a while, this guy named Paul Samuelson writes in the Journal of Portfolio Management that someone should just make a portfolio that tracks the S&P 500. So the idea is essentially to ride on the backs of all the investors actively working to figure out where to put their money and just putting in the same places. And by chance, this other guy named John C. Bogle, who just started a new mutual fund called Vanguard, read this article and thought it was a great idea. So he makes one. By buying all of the companies in the S&P 500 in the same proportion, Vanguard makes a single fund that gets the same returns as the S&P 500. And now you, an individual person, can buy a piece of that fund and take that portion of the returns. The first index fund. Bogle thinks this is the next big thing, but others don't. In 1976, the fund IPOs with the goal of $150 million investment and gets $11 million. Meanwhile, opposing fund managers who get money through fees try to kill indexes before they take any of their clients. One famous poster made by an investment group read, "Index funds are un-American," arguing against the conformity of just thoughtlessly following everyone else. But over time, the logic of index funds wins out. According to a 2020 analysis, 89% of all domestic funds underperformed the S&P 500 in the last 15 years.
There's no 20-year period of time where the S&P 500 has gone down, right? So over that long period of time, yeah, it's kind of true. Like the market does only go up.
Sometimes people do better, but over time, because it's so hard, if not impossible to predict the market, the likeliest success is the average.
I can't believe how much money I have. And my starting salary in 1992 was $13,900. And I'm, probably gonna retire with a few $1 million. It blows my mind away.
And buying an index fund can be even cheaper than an actively managed fund that has the same exact stocks, because there's not a team of analysts you're paying to decide what stocks to include. That's allowed companies like Vanguard to charge very low fees to buy into their funds. Across the market, index funds tend to charge between 0.2 and 0.5% of the cost of the fund to invest, while actively managed funds charge upwards of 12 times more, with rates between 1.3 and 2.5%. So in a sense, you can beat the market with an index fund, because as John C. Bogle would say, you get what you don't pay for. So while many people pay big fees to get market results, people invested in index funds pay smaller fees and thus get more of the returns. From 1980 to 2023, the percentage of Americans holding stocks went from 13% to 61%, which was fueled by the rise of 401k auto enrollment and companies like Fidelity that enabled regular people to invest. And now tens of trillions of dollars are sitting in index funds reaping the rewards of a great strategy. But not everyone thinks so. If we believe the efficient market hypothesis, the answer has to be that this line is just what things are worth. And we'd also assume that the giant fluctuations are simply due to tons of people individually making tiny little adjustments based on their own analyses. Generally, economists assume a marginal $1 invested into the market had nearly no impact, perhaps a cent. But a study from 2021 challenges this notion. This is one of the guys who wrote it.
My name is Xavier Gabex. I'm French, so I'm a professor of economics at Harvard University.
In his study, he and his co-author identify a system distinct from the efficient market.
Most investors just stay on the sidelines. They don't participate, or if they do participate in a very not particularly thoughtful and attentive way.
This is a big realization. The auction scenario assumes that the bidders actually care about what's in the box and how much it's worth. But the way a lot of non-professional investors invest today doesn't really make a difference. Hey, what's up? Just got my paycheck. How much for one share? $500. Sweet, cash it. It's payday. Deal me in two. $600. Works for me. One more from me. I feel bitter bad, but $800? Great, that means I can get two. Through the rising popularity of index funds and other passive investment vehicles, more and more people are simply piling money into the stock market, regardless of how much a stock is really worth. And according to Xavier and his co-author Ralph Koijin's Inelastic market hypothesis, this money coming in is inflating prices much faster than previously believed.
The surprise is how big the effect is. The stock market is this bizarre machine where you invest $100 in the machine and boom, the machine is worth $500 more. And of course it's symmetric for buys and sells.
So for every $1 that goes into the market, the overall value of the market goes up $5. And for every $1 that goes out of the market, the overall value goes down $5. It's a hypothesis because it's not a proven theory, but if it's true, this could mean that the market is moving at least 500 times as fast as we previously thought under the efficient market hypothesis. So what are the consequences of that? Well, this means that the market could be overvalued. And if enough people come to believe that that's the case, investors will sell their shares, which would send the prices of stocks down and cut the value of the investments many people have in the market. And given what the inelastic market hypothesis says about how the market works, this process could happen very fast. Beyond volatility, others worry index funds are overvaluing the largest companies as they systematically inject money into them. And with huge amounts of money under their management, some, including the founder of Vanguard, rest in peace, worry that companies like it are becoming too large and a significant portion of some companies' stocks are owned by index funds. But to push back on this charge, most people don't think indexes are a problem, at least not yet. In response to fears that passive investors are somewhat mindlessly paying whatever the market asks, a representative from Vanguard says passive investors have a tiny impact on how stocks are valued. A report by Vanguard found that at least 95% of the stocks bought and sold in a day are by active managers, suggesting prices are mostly determined by people who are well informed. So that would change the auction scenario to be more like this. Hey, what's up? Just got my paycheck. How much for one share? Based on our analysis, we believe the value is $312.42. Cash it. If this is true, there's a lot less to worry about. But Mike Green would urge us to not downplay the impact of quote-unquote passive investors. Even though they're supposedly just following the market, they are still buying and selling, which affects the pricing of stocks.
If you actually believe in the theories of passive, you have to accept that it is distortionary for you to decide to do anything in the market.
Still, if you ask a lot of investors, they'll scoff at these worries. My econ teacher is still pumping indexes.
I tell young people, and I teach this in my personal finance program, start early, save every month, don't touch that money, and just put your money into a stock index mutual fund. Always works.
When I asked a certified financial planner if he knows any doubts about index funds, he said,
people have doubts about index funds. That's interesting. I don't know too many people no, gotta go active management. It's the only way to go. I'm trying to give you an answer on that one. I don't think I have one.
And Xavier still thinks index funds are the best move for the average investor. The guy in charge of all of Vanguard's equity index trading was a bit more tempered and said past performance is not indicative of future performance, but most angles still support indexes. Returns continue to increase, American businesses have expansive global impact, and people seem bullish on their investments. And even if the stock market does end up going down, many would argue indexes are still the best way to distribute your risk. At the end of the day, the stock market is a lot of things. It's a marker of companies and their practices, it's a measure of hope for a better future, and it's a function of people's fundamental fears. And as long as the assumptions driving the market continue to lead the stock market up a hill, investing in index funds might still be the best move. After all, if the market moves up and you're not invested, you'll miss out on money.
So are you dancing while the music is playing?
Unfortunately, you have to, right?
But eventually the music might stop, or get quieter. So there's an argument to reducing your risk.
The market doesn't exist for retirement. The market exists to facilitate the addition of capital at an appropriate marginal cost. And so when we break those systems, I don't think we should be the least bit surprised that capitalism itself is threatening to break.
Ultimately, I'm not saying the stock market's going up or going down, but I hope this video leaves you with one insight. 50 years ago, a guy made a fund that couldn't be beat. Since, this simple idea has taken a hold among many investors, and for many, it's worked. But the stock market is not guaranteed to do anything. As much as we can break it down and average it, there's nothing ensuring that the stock market will go up forever, other than through the faith of investors. So, if you're investing, all I hope for you is that you understand why. Maybe it's because someone told you to. Maybe it's because you believe in the masses. But even if you're investing passively, be a little bit less passive of a passive investor. Man, this really gets my voice going. I'll lose it.